Hello and welcome. You're watching NDTV Profit. I am Harsh Saita and you're watching Know Your Company. Now today we're going to try and analyze TVS Supply Chain. It's an interesting play because one, it has been listed since August of 2023 and has given investors negative 33% growth since that point of time. Does supply chain really warrant that? Maybe not, but there's a shift happening. The top line shift is happening towards higher margin product, and therefore all of that will likely aid the bottom line. The expectation is a double-digit growth in FY26 and thereafter too likely a double-digit growth. They are targeting a 4% PBT from a loss currently. All of those levers are likely going to change the way the business is going to be looked at. I'm trying to dive deeper and trying to understand whether in this current environment, and there's a lot happening, right, geopolitically as well as on the tariff front, what's the likelihood of a double-digit growth in the current financial year? Because you have this company, 73% of the top line comes from international operations, and therefore, could that risk this particular guidance? That's my first point. My second point is with regard to what will drive this double-digit growth. And what I'm trying to delve into is trying to understand whether there is sustainability of that growth beyond FY26. What's the visibility like? What's the sustainability of that growth number looking like? The third piece is the PBT margin and the lever for it. So first one is, what's the likelihood of a 4% PBT margin? This is by FY27. This is the guidance given. And thereafter, what are the levers which the company is going to utilize to get to this number? Because right now you're a far cry from it. You're at sub 1% in terms of that margin number, and you're at a loss where the PAT number is concerned. Thereafter, so what will be the levers as well? The fifth point that I'm looking for is the risk on the global geopolitical as well as the tariff situation. All of that is leading to heightened uncertainty. But what are they seeing on the ground with regard to demand? Is demand remaining largely solid? Is it remaining largely robust? Are customers not shifting away from the supply chains that they've built as of now? And last one, how much are you growing? What's next for the India business? As they shift from India or within the India business towards a higher margin business, are they looking for what are the levers they're looking for, and how are they looking at the India business in particular is what I want to understand. So all of that and more, but essentially the bottom line is, can they do that top line guidance? Can they do that bottom line guidance? And thereafter, we'll try and understand what the re-rating could be as a result of that. So that will be the key which I'm looking out for. Let me now quickly start off with what the company does. And TVS Supply Chain, it provides logistics and supply chain management services. It's tech-led, asset-light in terms of its business model. It operates in 26 countries with its headquarters in India. 6,200 active customers globally is what it has. And it focuses on long-term contracts with Fortune 500 companies. So it's looking at companies with scale and size, both. And that's what they're really looking for. In terms of its services, and I've tried to keep this as simple as possible in terms of what services it provides. The first set of services is integrated supply chain solutions. Let me simplify this for you. It's simple. You take on a project from a customer. Say, for example, it's a plastic bottle manufacturer. What will they do? They will source plastic from somewhere, right? So the plastic will have to be sourced from a supplier. TVS Supply Chain will do that for the manufacturer, supply the raw material, right? Transport the raw material from the vendor to a warehouse, and thereafter transport the raw material from the warehouse on a need-based or a requirement-based timeline to the factory. Thereafter, take the finished goods from the factory to a distributor warehouse, and thereafter enable the distributor to distribute it further. All of that is currently being done by a TVS Supply Chain, and that's the type of service that they are doing. integrated supply chain solutions. That's what it means. Second one is network solutions, which is moving product efficiently. Now, whether this is from a global shipping standpoint, from one country to another country, or it's moving product efficiently within a factory. In-plant logistics, cold chain logistics, all of that is what network solutions is all about. We'll look at the split in terms of the top line now, and that's the split. 55% is integrated supply chain and 45% is network solutions in terms of the top line. That's the split. Mind you, integrated supply chain is a higher margin business. They're guiding for 9.5–10% margins there. Network solutions, they're guiding for a 7% margin. So that's something you want to keep in mind. Now let's look at the geographic split. They do just 27% of their business from India, 73% is international. The other piece you want to know is the revenue mix, and that becomes important as each sector likely slows down, another sector gears up. That could well influence some of the numbers as well. They have a fairly diversified pie in that sense. Last off, customers, they service 91 out of the Fortune 500 companies. So 91 customers out of the 500 top companies globally is what they have on their customer book. The customer contracts are usually 3 to 7 years. You look at the way in which some of the customer contracts are slated. Europe over UK over North America, NA is North America, and over India. So India in terms of pecking order is probably the last, but Europe is the largest focus, and that's good news given the tariffs coming from here. What you also want to see is the contract duration, which gives you certainty on how long the contract can last for. So the average contract duration is 3.9 years for India, 4.2 years for North America, and 7 years for Europe. So you've got far more certainty coming out of Europe than out of India. But nonetheless, it's a company based out of India, and therefore you're okay with living with that kind of a risk. So broadly, that's all about the company. Now let me quickly take you through the metrics we'll dive into, and we'll dive into it very, very quickly. We'll start off with the income statement, the balance sheet, the cash flow, the return ratios, the shareholding, street cred. Thereafter, we will look at outlook and we'll dive into valuations. And some of this is subjective, so you want to keep and monitor this one if you were to look at this. So let me start off with the income statement. Very, very unimpressive, but they've held on to the top line. They've got a decent order book. They've got decent recurring revenue. We spoke about the contracts which they have as well, 7 years. So therefore, there's some bit of certainty with regard to that top line number, and hence we've given this a neutral, even though it's a very uninspiring set of numbers that you can see on your screen. Nothing at all that really stands out. 3% growth ideally would have been a thumbs down, but for the fact that some of the factors which I've just listed. In terms of Q1, performance was strong, but outside of a one-off, it was largely a subdued performance, just 2% YOY growth seen. Let me talk about margin trajectory now. The margins have largely been very, very range-bound, between 6.7 and 7.7. So very, very range-bound margins, more so between 6.7 and 6.8. Broadly, that's the take. Let me now look at the balance sheet, and we've given this, of course, a neutral for you to remember. Balance sheet, book value is at 1800 crore, market cap is at 6000 crore. The borrowing number is roughly 860 crore. Now, mind you, some of the borrowing number is, or a predominant chunk of it, across years is short term, and that is because the receivables and some of the working capital requirements which the company has to set aside is large, which is why you've got that borrowing number which is elevated, and those receivables are back to back. So as soon as they receive the amount, they pay it off and they close the short term borrowing number. That's what you want to keep in mind. That's part of the structure of the business. That's just how the business is structured. Balance sheet kind of gives you that. Cash, enough and more cash, 600 crore on an 860 crore borrowing, no concerns at all, and therefore we've given this a thumbs up. So just perspective. Quickly on to cash flow, and this will also reveal some stuff. FY24 was a year where they did not use factoring. What is factoring? They have some receivables, they go to a bank with those receivables, they tell the bank, you keep 2%, give us the balance amount, that frees up cash in my books. That's what they did up to FY23. FY24 post the IPO, they didn't need that cash. Therefore, they said, okay, let it sit in receivables, which is why you're seeing the sudden drop in CFO to EBITDA. That's where the mismatch is coming from. FY25, again, it's smoothened out because all of that working capital which is blocked, there's not been an increase in that working capital, which is why you're seeing what you're seeing. So no concerns with regard to this one either. We've given this one a thumbs up as well. Now, let's look at return ratios. Again, very uninspiring, thumbs down on the return ratios. Mid-single digit, not looking good at all. So we've given this one a thumbs down. Shareholding, 43% held by the promoter group. FIIs on your screen, so is DIIs, public too. Now, given that this is sub 50% held by the promoters, as we always do, we've given this a neutral on that count. Now, let's talk about street cred. Again, the numbers very, very uninspiring. You look at the returns which shareholders have got, well, it's a tough one for a shareholder to continue to hold. Therefore, we've given this a thumbs down. Now, let's look at the outlook. And in the outlook, they've guided for double-digit growth in FY26. They've guided for 4% margin in FY27. And they've said EBITDA margin guidance for ISCS, which is 55% of the top line, we spoke about that, is 9.5%. And for the network services business is just 7%. Broadly, that's the take. What I've done is I've just extrapolated a 10% top line growth for FY26 and FY27, not even higher than 10%. And what I've thereafter done is given a 4% PBT, 3% PAT number to this and given it a valuation. So what we've done in terms of the valuations is we have given outlook a neutral. We'll want to see whether that execution actually plays out. And valuations, this comes to around 18 times price to earnings. What this does versus some of the competitors on your screen. So that gives you a perspective with regard to valuations as well. Beg your pardon. So that's how it plays out. Overall, let's stack up all of the metrics on a TVS supply chain, and what it will give us broadly is a 4 out of 8 on our KYC ratings. That's how it all stacks up. Of course, a tough environment that the company has gone through, but can they turn it around? And we'll speak with the management right off to try and understand that. Let's go across. We have Ravi Viswanathan, who's the Managing Director at TVS Supply Chain, who's come in to speak with us today. Sir, let me start off apologies. We have Ravi Viswanathan, but we also have R Vaidhyanathan, who's joining us, who's the Global Chief Financial Officer of TVS Supply Chain. Apologies for that. Mr. Viswanathan, let me start with you first. Let me try and understand, is this 10% growth FY26 possible in this environment? It is this high levels of uncertainty at this point. So give us a perspective on that first off.
No, thank you so much for having us, and it was good to see your coverage. Let me start by saying our business has got two components, right? The ISCS segment and the global freight business. Yes. The global freight business definitely has dependency on all of the uncertainty that's going on that we are all talking about on a daily basis, and that's something which is creating a lot of volatility. But if you look at the integrated supply chain business, it's a steady business. It's got large contracts, like you pointed out in your analysis. It is long term, and it gives us sustainable margin growth. So if I look at your question on, is the 10% possible? I look at the lead indicator. The lead indicators are the pipeline. The pipeline is 5,300 crores, and it's continuously been improving. If you look at it from what we've been publishing, and every year we typically have about 10% revenue coming from new business. So this is something which we are comfortable with. Our pipeline gives us good, I would say, confidence getting out of Q1. Of course, how the macro plays out is anybody's guess. At this point in time, I think the ISCS business is relatively calmer. The global freight business is definitely a bit more volatile. So I hope that gives some color to what I was trying to give as a response to your question.
Certainly does, Mr. Viswanathan. And before I go to Mr. Vaidhyanathan, let me ask you one more. FY27, what is that growth number that you'll be looking for?
So our guidance is to double-digit growth. We would like to get to mid-teens. Given the pipeline and some of the advanced stages, some of the large deals are in the pipeline. there's every confidence that in FY27 we should get to early teens, if not mid-teens, in terms of revenue growth. But I think the key for us is the PBT. We are on a strategic transformation program across the company, and our commitment towards a 4% PBT by Q4 FY27 is something which we want to make sure that we live up to. And towards that, we have taken a series of programs which are already on the way, and we clearly have a very, very strong roadmap in terms of managing our cost structures and driving leverage, which Vaidhi can throw more color on, to ensure that we hit the 4% PBT target. So we are definitely going after both the revenue engine and the cost engine. A lot of focus right now. The market is what it is from a revenue. We have to live through the uncertainties, but what we can control is the cost much better, and that is where the strategic initiatives are playing out. And I think as we exit FY26, you'll clearly see that linearity moving towards an exponential path.
Understood. Mr. Vaidhyanathan, it's an uncertain environment. We did speak about that. In such an uncertain environment, how do you plan to drive operational efficiency within a business which hasn't done as well in the last 3 years as one would have hoped? So what changes?
Yeah. So I think as Ravi mentioned, what is in our control is only the cost, right?
Right.
I think we have taken a lot of series of actions in order to re-baseline our cost. And one of the critical things is, the IFM turnaround that we were able to do last year, which is giving results the current year. Similarly, the project one, the initiative that we have taken to completely transform our UK and Europe business. Again, this is primarily driven at the market, but also there is a lot of cost benefit towards that. So all these things, these are under our control. And irrespective of the market, playing out, I think we will be able to control these first to improve the profitability going forward.
Understood. So, what could you give us specifics on what will help get you to the 4% PBT? What costs are you planning to control? Give us and our viewers some bit of clarity on that.
Sure. For example, right now we are about 0.5%. To reach that 4%, there are three broad levers that is playing out. One is the integrated final mile business in the UK, which should give us an additional 0.4% of profitability improvement. We have taken a lot of strategic actions there, including a one-time price correction, which will give us a significant improvement in the profitability of the IFM business. The second big lever is the project one, which is the integration of our ISCS business and IFM business in the UK and Europe. Again, that is expected to give at least 100 to 120 crores of cost benefit from FY27 onwards on an annualized basis. There will be benefits in the current year as well, but on an annualized basis, the benefits could be about 100 to 120 crores. The third big lever is for us the operating leverage. The cost reduction program that we are running across all the geographies, not only UK and Europe, but also in India, Asia Pacific, as well as in North America market, that will also significantly give us the operating leverage. So all these factors combined together with the double-digit growth which Ravi was mentioning to help us take it to the 4% PBT.
And sir, how quickly do you see this translate? So take us through the journey, Mr. Vaidhyanathan. Will it be 2% PBT this year? Will it be 3% PBT this year and thereafter 4? Will it be immediate 4 in FY27? Give us that color. Give us the timing.
Yeah. So I will not be able to give you specifically in terms of what we expect FY26.
Sure.
But you can say that sequentially there will be an improvement in the PBT because all the actions that we have taken, when we start setting the benefit, sequentially we'll start seeing the improvement in the PBT.
So Harsh, let me just qualify that by saying, look, we don't want to guide the market towards FY26, but we will exit FY27 Q4 at a 4% PBT, so that you can then build that chart. Like Vaidhi said, about 0.4% coming from IFM, 1.2% coming from the Project One initiatives, and the rest coming from the leverage to a base of 0.5. And that's and with all of these measures already kicking in, that's why I said we will move from a linear to a slightly more exponential trajectory as we exit FY27.
Got it. Mr. Viswanathan or Mr. Vaidhyanathan, whoever this is maybe relevant for, working capital, there was a one-off there in FY24. There was an adjustment which happened, and we explained that to viewers. Is that a thing of the past, or do you continue to believe that that may be a concern in the future at some point as well?
The working capital is at a optimal level, I would say, the business that we are currently in. And it will continue to, as the business grows, the working capital requirement will grow. I think FY24 was a one-off move because we came out of the factoring. But I think broadly, I think we are from an optimal point of view, I think we are very, very comfortable.
Mr. Viswanathan, talk to us about the sustainability of this 4% PBT and talk to us about new order wins that are coming your way. What's the traction looking like in this environment at the current juncture?
Right. I think let me first talk about the opportunities and the orders.
Sure.
Clearly, our pipeline is continuously growing. We are winning large deals in the market. The ISCS segment typically has a longer gestation period in terms of converting those contracts, and we have contracts at multiple stages in the funnel when you look at the pipeline, and therefore the confidence of having a sustainable double-digit revenue growth is pretty high. The key for us, of course, is the execution. We think the first step is to get to the 4% PBT. But as we exit FY27, a lot of things that we are doing today in terms of investment in AI, in agentic AI, all of this should play out, and that should start giving us incremental opportunities to increase our PBT from 4 and beyond. In the investors meeting earlier in the day, we said the best-in-class operate around 8% and some at a slightly higher number. So our first step is to get to 4 and then build a plan to get to the 8 in the mid to long term. And for that, we have to, as a company, imbibe AI. We have started multiple projects. We have AI deployed in scale in the US, in India, and also in the UK.
Right.
And we expect that to take more prominence as we go forward.
Right. Mr. Viswanathan, would it be prudent to say 8% by FY30 is the aspiration?
It's probably early to jump to that, but we will most definitely make a projection as we exit FY26 and as we see the trajectory evolving.
Sure.
But clearly, internally, we do have a plan which probably we can share by the end of the fiscal.
Excellent. Thank you so much, both of you, gentlemen, for joining us and giving us that perspective. We'll let you go on that note. And viewers, frankly, completely out of time on this edition of KYC. So we're going to close this show here with a 4 out of 8 on the current KYC rating of TVS Supply Chain.